It's a pleasure to be moderating this panel today. The American Council for Capital Formation has been, since I've been in this town, I've always found it very rewarding to participate in their events. They always bring a lot of interesting people together to talk about the biggest issues of the day. Now, I have to say, I've been writing about economics and finance policy for quite a few years now, and historically, the two surefire subjects that would put your audience to sleep were international trade and tax. So if you had told me that hashtag DBCFT, destination-based cash flow tax, would be trending on Twitter in the year 2017, I would have told you were nuts. But in fact, that is what is happening. In fact, just from my personal experience, the articles we have written on this subject have attracted more reader attention than almost anything we've done on economic policy so far this year. So I know there's just enormous hunger around this issue, a lot of which just boils down to, like, what is this thing? And secondly, what does it mean for me? And how likely is it? And I'm very pleased that we have the three panelists that we do have here today who are incredibly authoritative on this subject. Of course, when it comes to destination-based cash flow tax, we're all kind of like groping different parts of the elephant. We're all kind of like blind men with sort of like different degrees of visual impairment, but these people are less blind than average. So I'd actually, Alan, I want to start with you, though, just ask a really basic question. I think everybody knows what a corporate tax is. Most of us know what a value-added tax. And this tax that we're talking about seems to be an amalgam of the two. Can you explain to us basically how this tax works, or is supposed to work?
Okay, so conceptually, a cash flow tax is a value-added tax with a wage deduction. In practice, there may be other variations, and there certainly are in the House blueprint, not to mention what may emerge from the congressional process. But conceptually, under a value-added tax, firms remit tax based on the purchases, on the sales that they make to consumers and to other firms, minus the purchases that they make from other firms. And the cash flow tax proceeds the same way in that but it also allows the firms to deduct their wages. So a much smaller tax base and a more progressive one. Now, VATs are border adjusted, meaning that the tax is rebated on exports and that a tax is imposed on imports as they enter the country. A cash flow tax need not be border adjusted in that manner. For that matter, a VAT in principle need not be border adjusted either, but all of them are. The House Republicans have chosen to border adjust their cash flow tax, so that makes it a very close match for a border adjusted value added tax with a wage deduction.
And Michael, why are we talking about this tax now? I guess what I want to know is what specific peculiarities or flaws in the existing U.S. tax would this particular tax concept fix?
Well, the reason we're talking about it now, I suppose that's on, the reason we're talking about it now is that the leadership of the House and the Republicans in the House put out a blueprint last summer basically suggesting this tax. I would note that when they put it out, the gambling odds of Hillary Clinton being president were extremely high. And so I think they were really putting it out as something to be talked about over a long period of time. Because it is, I mean, you know, Alan correctly made it sound familiar, but it is unique. I mean, that is, there is no place in the world that has this tax. Many countries have value-added taxes. Many countries have corporate income taxes. Most countries have both value-added taxes and corporate income taxes. Here, what you're doing is you're replacing the corporate income tax with what I call a cousin to a value-added tax. But that may be because I grew up in the South and everybody's a cousin in the South. It's a cousin to a value-added tax. And the big difference, well, there are two big differences. One is that value-added taxes generally are collected on a credit invoice method. And that means you only get a credit for the tax if you've got an invoice showing that somebody else paid the tax. This is what's known in the business as a subtraction method value-added tax, and you can show that in principle a subtraction method value-added tax and a credit method value-added tax are the same thing, because it doesn't matter whether you're getting a credit for the taxes paid or you're getting a deduction for for essentially exports and not getting a deduction for imports. That's true in principle, but the enforcement issues, I just want to underline this because I'm sure we'll come back to it, but the enforcement issues are really quite different if you're doing it through deductions and you do not have invoices. And nobody in the world does that. I mean, that is, there is a variation of a pure subtraction method value-added tax in Japan, but they've moved to a credit invoice method of collecting it because of all the problems they were having. So if you don't understand this tax, welcome, because it's new. It's something completely new. It does solve, so what was pushing business tax reform, let's talk about business tax reform. What was pushing business tax reform was that our tax system is archaic in a number of ways. First, the 35% rate is the highest rate. It was the lowest rate when it was enacted in 1986. Everybody else has lowered their corporate rates. Most of them have paid for it by increasing their value-added taxes. And we've held pat. And if you've got the highest corporate rate in the world, that is essentially a signal to any tax planner, including my poorest students, to locate your deductions in the country with the high tax rate and move your income to countries with a low tax rate. And so that's what we're doing. We're attracting deductions for royalties and for interest, and other countries are attracting income. And this is not where you'd like to be. This is a poor design. So there's been a desire to get the rate down. There also are a whole series of international issues that have troubled the G20 in particular, who in their base erosion and profit shifting program, which they instructed the OECD to do, known as BEPS in the trade. In the BEPS process, they tried to align taxation better with where economic activities are occurring. I'm of the view that this is to our disadvantage in lots of ways, because rather than just moving paper, we may have to move jobs in order to comply. So this is not something I'm fond of. There are transfer pricing issues, and of course there is the problem that we have, I think now nearly $3 trillion of U.S. assets located abroad in some sense. They've not been repatriated to the U.S. parents because you'd have to pay the difference on whatever tax they paid, often close to zero, and the 35% rate that we would impose in order to get them back to the country. And the great advantage of this tax, and of a value-added tax, I might say, I've long proposed that we take a value-added tax and use it to buy down both the corporate and the individual income tax, and the corporate income tax in particular, to a low rate. The advantage of that kind of tax is that these issues disappear. That is, you're taxing income where the sales or the purchases of goods and services occur. And that means that neither the corporate headquarters nor the location of production matters for this tax. And by shifting away to where consumption occurs, to where the consumers are, rather than where headquarters are, you avoid the problem of corporate inversions, you avoid the income shifting issues that I just described, and you clean up a lot of issues of international tax. And one last word, I don't want to go on at great length for what was a short question. One of the difficulties has been, and Chairman Camp of the Ways and Means Committee a few years ago demonstrated this in great detail to his great credit, one of the difficulties has been that on a revenue neutral basis, you can only get the corporate rate down to about 25%. The Obama administration said 28, and Camp said 25, but it's in that range. And one of the attractions, I'll put it this way, one of the attractions of this tax is that because our trade balance is so out of balance and so out of whack, we now have $600 billion of imports over exports. And if you tax that for the next 10 years and you assume it will be sustained for the next 10 years, you will get $1 or $1.2 trillion of revenue during the 10-year budget window. Now, Alan has written, and he may want to comment, that this is not real money. It's not money that we're borrowing in some sense, I think is the way Alan put it, but I'll let him describe that. But if it counts for scorekeeping, it lets you get the rate from the 25% or whatever, 28% down to 20%. And so that's in the congressional process an important advantage. And so it's a combination of the desire to get to business tax reform and eliminating some of these international tax issues and coming up with what seems to be a pot of gold at the end of this rainbow in terms of revenues.
Thanks, Michael. I will come back to that, but first I want to bring Gary into the conversation here because one of the big appeals, I think, to some people of a value-added tax framework and border adjustability is that for a country with a large trade deficit, as the United States has, it seems very appealing that you would tax imports and exempt exports, and that would make us more competitive and basically shift the cost of this burden onto our trading partners. Is that a correct interpretation of this? What will this tax do, if anything, to our trade competitiveness?
Well, there's a big debate on that, and you'll find economists at both ends of the spectrum. So one school of thought, which is led by Alan Auerbach, Douglas Holtz-Eakin, and Marty Feldstein, all distinguished economists, tells us that the nominal exchange rate, that is the dollar relative to the trade-weighted average of our trading partners, will very quickly appreciate to exactly, well, not exactly, but very closely offset the border tax adjustment. So in that world, and they've got a good model for that world, there is no effect on importers, such as retailers and oil refiners, because with the dollar appreciating, their imports in principle should be cheaper, just offsetting the border tax. And the further implication is that there's no change in the real trade balance that is measured in dollars prior to the appreciation, because the dollar appreciation just offsets, both for exports and imports, the tax. So that's one school of thought, and that school has been embraced by many proponents in the House as an answer to those who fear that the tax means that they pay a lot more for their imports. Okay, there are other schools of thought. One other school of thought is that it will have no impact on the exchange rate. The exchange rate is essentially a financial variable. The quantity of financial transactions daily is 4 trillion, and the quantity of trade transactions monthly is 400 billion. So hey, what's the dog and what's the tail? So on that argument, you're not going to see any impact on the exchange rate, and so the result will be that it will be equivalent to a dollar devaluation, because imports are now 20% more expensive and exports are 20% less expensive because the tax is not imposed on exports, and therefore it's roughly equivalent to an exchange rate change of that amount, 20%, and the trade balance will therefore shrink by an appropriate amount. And my colleague William Klein has done some arithmetic on that, and he says that it would be about $200 billion of of trade balance effect for every 10% of exchange rate depreciation, well, if there's a 20%, you've got $400 billion. So a pretty hefty numbers, so that reduces our trade deficit, which last year was $500 billion very sharply. Those are two very different stories. Now, some people will try to tell both stories. They are inconsistent, but that doesn't matter because for political reasons, consistency is the hobgoblin of very little minds, so we're not going to worry about that. Now, in between these two stories is a school of thought which some of my colleagues at the Peterson Institute advocate, which is that what happens is that the real exchange rate appreciates. Now, the real exchange rate is the nominal exchange rate adjusted by domestic prices of traded goods, of the traded goods sector. The domestic prices here and amongst all our trading partners. I know that's kind of a bit gooey, but that's the real exchange rate. And my colleagues looked at the experience of value-added taxes, both initial imposition and increases, in about 14 industrial countries. And they concluded that very largely the real exchange rate does offset the tax imposition. That's the real exchange rate. However, is that in their findings for most countries, most of the time that had these value-added taxes, most of the real exchange rate adjustment was not to the nominal rate, but through prices going up in the country with the value-added tax. So now that, so that would come back in terms of the trade balance to the kind of Auerbach, Holtzik, and Feldstein
Gary, can I
story.
stop you for a second? Did those studies find the price effect was on the entire price level or just the tradable sector?
No, the traded goods level, the traded goods, which is a big part of the
So
economy.
relative prices
It
of
may not
traded goods went
affect-
up?
It may not,
Right, the relative price of traded goods went up.
yeah, right. It may not affect your rent, Greg, but all the stuff you can move, like this table, this, those chairs out there, that was affected. That was their finding. That's their finding. And that's not all goods and services, but it's a big part. So that's their findings. So to continue on that story, you get the same, if you do it diagrammatically, you get the same effect on not much change in the trade balance, but the pain is very different, and pain counts for in the political market. So prices, first of all, prices moving up, that's not very popular with most people, and that's why imposing the consumption tax, which is what they call it in Japan, and as Michael has correctly noted, is a subtraction method, VAT, was very unpopular in Japan, even though the rate was only started at 3%, went to 5%, now it's at 8%. And the goods and services tax in Canada was very unpopular, and in Australia and many other countries which have introduced these kind of taxes get unpopular because of the price effect. And the price effect may be very uneven from one sector to another and may take some time to work itself through. So that's kind of a big difference from the quick adjustment of the nominal exchange rate, which, is right across the board because everything is affected at the same time. So that's a kind of a range of what the economics says. And I have to say that there was one country where the nominal exchange rate did exactly what Auerbach and Feldstein and Holtzik can say, and that was New Zealand. But there are a lot of differences between New Zealand and the United States. I won't bother to tick them off here and bore you, but you can think of them yourself, of course. But in the other countries, it was more like the story I just told. So the debate, I think, very much in the Congress will be between, as far as the adjustment goes, which of those three stories do you believe most, and which one are you pegging your hat
Gary, in
to?
any of those versions, does the trade deficit actually change?
Yeah, and I guess I was speaking too fast, Greg, because I said, look at the exchange rate arguably is a financial variable.
Right.
And the amount of finance traded daily, I tried to emphasize that, is $4 trillion. The amount of trade traded monthly is $400 billion.
Correct.
where's the dog and where's the tail?
Right.
The dog is the financial markets. And on that argument, you know, how can this little bit of trade, 400 billion a month, affect this huge flows of finance?
Okay.
So why should the exchange rate change at all? And I can toss in some other arguments, such as we may have spare capacity in this country. We have a lot of companies who can produce pretty close to what's imported. Their taxes on the corporate side are going down. This tax is coming in, but it's not exactly offsetting. So in terms of their tax burden, it's reducing. You know, why do they need to increase their prices? Why not just leave the prices the same and go for volume? And then there's an invoicing issue. I won't go into that now because of time, but there are a lot of reasons to argue that, you know, you're not going to get a price adjustment, you're not going to get an exchange rate adjustment. And if you don't get either of those, what do you get? You get a trade balance adjustment.
Alan, I think you wanted to.
Yeah, I just wanted to kind of elaborate on, so the standard economic theory, I mean, which I think it's a little narrow to say that it's, you know, Feldstein and Auerbach and Holtz-Eakin, because I think it's been the, you know, kind of dominant, you know, view for many decades, and because it's such a well-established, theoretically constructed model, and obviously people could debate its applicability, but theoretically certainly quite appealing. That theory doesn't say that it has to be the nominal exchange rate that adjusts. I just want to be clear on that. I mean, there's nothing in the standard theory which says that monetary policy would be such that the nominal exchange rate ends up altering. I mean, the economic theory of the border adjustment says that if you put a 20% tax on the net purchases made by one group from another, then the prices paid and received by the first group need to rise by 25% relative to the prices paid and received by the other, by everyone else, when those prices are expressed in any common currency. So in the case of the United States imposing a 20% border adjustment on its net purchases from the rest of the world, the theory is perfectly compatible with the US price level rising by 25%, while foreign price levels and the exchange rate stay the same. It's perfectly consistent with the US price level and the exchange rate staying the same, while foreign price levels fall by 20% in foreign currencies. It's perfectly consistent with the US and the foreign price levels both staying the same in their own currencies, and with the dollar appreciating by 25%. And it's also compatible with any mixture of those three possibilities. It depends solely on monetary policy which of those three things occur. The important thing to realize is that under any of those monetary policy responses, in a simple model that abstracts from any investments with above normal returns, that assumes that markets function perfectly, that assumes there's no cross-border asset holdings when the border adjustment is introduced, under any of those monetary policy assumptions, there's no real effect on trade. And so I do want to say it's not really a question of, like, is it the nominal exchange rate that changes? But the question is, do you get this price change, relative price change that offsets the border adjustment and leaves real trade flows unaffected?
But Alan, there's a very big difference between the experimental evidence that Gary talked with respect to the price level and what you're talking about. You're talking about the entire US price level going up by 20%. Gary is talking about only the prices of tradables going up, so that the prices, so that the competitive benefit of the tax is lost via the prices. But that basically means that in the United States, the companies that produce oil and lumber and cars, anything in the tradable goods sector, will suddenly receive this huge nominal wage and price increase. Now, that surely must have very large distributional effects within the U.S. economy if that happens.
Well, if that happens, sure. I mean, but again, the theory, says that you're going to see the same, the no change in the relative price of tradables and non-tradables. So I guess I'd be interested in seeing whether the evidence really does show a significant change in the relative price of tradables and non-tradables under a border adjustment that actually applies uniformly.
Yeah, well, I commend you to look at the paper by Joe Gagnon and Carolyn Freund, which is on our website, and you can study that and decide how it goes. But I want to emphasize, in contrast to Alan, that the real world does not work according to these wonderful models. First of all, it doesn't have very much on financial transactions. Secondly, there's no friction, and everything is kind of smooth and it's just all kind of works like a perfectly oiled machine. And if people believe that, there would be two consequences in the real world. First of all, you wouldn't have retailers in this country, oil refiners, and some other firms so agitated about this because, you know, it's all going to be taken care of by this frictionless model. The second consequence, which runs right through history, is that, so far as I know, Michael may correct me, no country has adopted a value-added tax without adjusting it at the border. No country. Now, maybe they're all dumb, and they haven't been, you know, they haven't read, you know, you know, they just didn't study Economics 1 very well, and they just didn't learn, and they studied and they forgot it. But it is remarkable, because if there's no effect of all this, why didn't at least 10 out of the 165 countries which have value-added taxes not bother to adjust it at the border? Well, because they don't believe the frictionless model.
So Greg, can I make an observation on this debate? You know, I always say I'm just a country lawyer, so I don't know what will happen, whether prices will adjust or whether exchange rates will adjust. But I think that both have risks, and I want to just talk about the risks of both for a minute. Prices going up, we understand the risks. One of the things about this tax is that because of the deduction for wages, which eliminates about 70% of value added, the tax rate has to be 3 times higher than it would be if it were a value-added tax to raise the same amount of money. So you could do it at a 6%, roughly 6 to 2/3% value-added tax, and get the same revenue. It would have different distributional consequences, and you'd have to do something about wages. But having said that, these effects are much smaller at much lower rates. And at a 20% rate, we're talking about a 25% adjustment. And because it's 20%, I'll say this quickly, and then you just forget that I said it, because it's tax inclusive and the value-added tax rates are tax exclusive, so it's 25% versus 6.5% is the right comparison. In any event, if the exchange rate adjusts, I just want to mention 2 or 3 effects that I've noticed. One is that U.S. holders of foreign assets will lose 25% of their value if they adjust by 25%, as the theory projects. And there is $24.5 trillion of U.S. holdings of foreign assets. They're losers. You can do the math. On the other side, there are $32.5 trillion of U.S. assets held by foreigners, and they gain because the exchange rate goes up. And so their gains are bigger. I can tell that 32 is higher than 24.5. So their gains are larger than the losses on assets. Debt, you get the reverse story. And on debt, one of my concerns is the vast amount of sovereign and corporate debt that is dollar denominated, so that countries like Mexico, Brazil, Indonesia, Malaysia, Turkey, all have issued their sovereign debt in dollar denominated amounts because other people don't want to take the currency risk and they're not willing to hedge it. And many of their corporations, many of their non-financial corporations have also issued dollar-denominated debt. Well, that debt is now immediately 25% more expensive to them in terms of their own currencies, if the dollar rises. And so I think that there is this question, right? We know that either the dollar has to rise or prices have to rise. The theoretical economist and theoretical economics suggest the dollar is going to rise very quickly. I've seen reports by financial institutions, big financial institutions, where their economists say a number of things. Some say, well, it'll take several years. Others say, well, it'll only affect the traded sector. Some say it'll take a number of years. It depends on what our trade balances are, and some countries, shockingly, don't let their currencies float freely against the dollar, and so they may participate in this through currency adjustments. And so we know what the price, so some combination of exchange rate adjustments and price adjustments has to happen with this tax. And I think, at least I'm wondering about the risks of either. So you will get, I think Gary made this point, you'll hear from different people depending on which one they believe or which one, which one gores their ox. If you're a retailer and you don't know, you're going to worry about the price adjustments. If you're a sovereign debt issuer, you're going to worry about the exchange adjustments. And if you're a financial institution that owns a lot of that debt or something, you may also worry about that. So I think that it's important to recognize that some combination of these things will happen, and however it's split, there are going to be some important consequences from it that would be much, much smaller with a value-added tax of, as I say, a much lower rate.
So,
Could I agree? I have to add that it's a three-way split. I agree with 90% of what Michael said, but it is a three-way split. If you believe that exchange rates make a difference to trade balances, if you believe that, then it's quite possible that this border tax adjustment also makes a difference to trade balances. Now, if you believe that exchange rates make no difference whatsoever to trade balances, which is kind of the Auerbach-Feldstein world, then, okay, exchange rate goes up, goes down. It's the S minus I relationship of macroeconomics which determines it. But my lifelong colleague Bill Klein at the Institute has done enormous research on this, as has the fund, as have other empirical economists, and exchange rates apparently seem to make a difference in trade balances. So part of the adjustment could be in the trade balance. Now, if you think we're at an absolutely full employment economy, which obviously President Trump does not, then you'd be more skeptical of any impact on the trade balance because, any additional shrinkage of the deficit would just turn into inflation. But we may not be at the, if we're not at the full employment economy, then there's maybe capacity to export more and import less, drawing in spare resources. So I'd say a three-way split.
Well, I have to just interject a couple things briefly. So first of all, I don't think it's correct at all to characterize Auerbach or Feldstein or Holtegen as saying that exchange rates don't affect the trade balance. Again, the theory holds perfectly well regardless of how sensitive the trade balance is or is not to exchange rates. The point is that the border adjustment is itself, if uncorrected by exchange rates, is a change in the terms of trade, and the exchange rate adjusts to offset that. And then, of course, that offsetting combination naturally has no net effect. I also do want to emphasize, again, nothing in the theory says whether it's the overall price level or the nominal exchange rate that adjusts. That depends on monetary policy. What the simple theory is saying is that it would be neutral in the simple model because that the relative prices here and abroad, when expressed in a common currency, that there'll be this 25% wedge. But I do think that the cross-border asset holdings that exist when the border adjustment is put into place is probably the biggest single effect of the border adjustment. So Michael was talking about that. And so I think that the attention really needs to focus, in my opinion, not on the trade effects, which I think would wash out maybe after some brief adjustment period, but instead these effects on the incentives to make high return investments, the transfer pricing incentives, and this impact on the initial cross-border asset holdings.
well, let me pick up on that. So the typical U.S. multinational enterprise has both production and sales operations all around the world. And today they've tended to optimize that so that they produce services and inputs in a variety of markets, and they all come together through a multi-country supply chain. And they sell in other countries. That's true in the manufacturing area. It's true in the commodities area. It's true in the services, the financial services area. How is the typical multinational likely going to have to adjust how it runs its business as a result of this tax, given what we know about the taxes outlined so far? Yeah, let's
Sorry,
go
we'll
down.
probably
the
all
list. Sure, yeah,
comment on
yeah.
it. Yeah, so, well, I think again, I would say the two main impacts would pertain to the impact on initial asset values that the foreign holdings, foreign investments that are in place when the border adjustment is announced would go down in value, as Michael noted. Going forward, I think the biggest, effect is that there would no longer be a tax penalty on making high return investments in the United States, and there would no longer be a tax penalty on booking those high returns into the United States. And so you would expect to see both an increase in real investment in the United States and also an increase in, the accounting mechanisms that book profits into the United States.
I think I'm in agreement with Alan, but it's always a little questionable here. The way I would put it is this: as Michael said to begin with, I would reduce the incentive for multinationals to book profits in Ireland and book expenses in the United States. That's pretty clear. In addition to that, I think it would have a substantial real impact on firms seeing the United States as a more attractive place to put new production facilities, whether they be service facilities or factories or whatever, and to keep their headquarters in the United States or even move their headquarters in the United States. In other words, real impacts as well as just the purely financial impacts. So I think we're in agreement on that. It would be, I think, a pretty substantial thing over a period of a decade.
Yeah, I don't disagree with that. I think that, when you stop taxing production here and you stop taxing headquarters here and you start taxing sales here, you're going to get more production, more headquarters, and only sales will be affected. And I don't expect them to be affected too much. But I want to say, from a tax planner's point of view, it's very hard to know what this tax looks like. And I'll just give you a couple of quick examples. So if I'm an exporter and I get a wage deduction, I know the revenues from the export are not included in my income and the wages are deductible. I'm going to have losses, and I'm going to have losses forever. And, we're going to give you a carryover with interest is what the blueprint says. Well, I may not like a carryover with interest. I may really like the cash now. And so historically, we saw what was known, there are a few people in the room who will remember this, safe harbor leasing, where you could engage in a lease transaction instead of a loan transaction and shift your losses to somebody who could use them. You're going to definitely see some tax-induced mergers depending on how this goes, more so than currently. And let me just make a footnote about the merger point. Under this tax, which allows you to deduct capital expenditures, in the normal course of business, you get to deduct your purchases of real assets, but you don't get to deduct your purchases of stock in another company. Well, what am I going to do about a merger? When am I going to know whether I've got a merger? If I have a transaction with a line of business, if I need the deduction, I'd rather buy the assets. If I don't need the deduction, I'd rather buy the stock. One more, and then I'll stop. I would like the losses actually to be in a partnership where I can, under at least current law, allocate those losses to the partners who can use them. And then it'll appear on their tax returns and reduce their individual losses. So I want to put my losses in a partnership and my gains in a corporation. And just one other thing, unlike any other cousin or relative of the value-added tax, the House Blueprint has different rates of tax on corporations and on partnerships. So there's a 25% rate on partnership business income after some deduction for reasonable compensation, they say, however that will work out, and a 20% tax at the corporate level. So what do I want to do? Well, I want to put my imports at the low tax place because the deduction is going to be disallowed. So I want my imports in the corporation. I want my exports in the partnership against the 25% rate where they would be taxed, and so forth, right? I'd like to buy my inputs from a tax-exempt seller because, I get to deduct my inputs and they wouldn't have to include it. And that could be either I always tell my students, there are lots of zero-rate taxpayers who have lots of real assets, and I always mention the Yale, Harvard, and Columbia universities to them. But there are state and local governments, and then there are a lot of companies with losses, and so I'd rather buy, right? I'd rather another way to deal with the loss problem. So there are a huge number of unexplored transactional issues, and I've just hit the tip of the iceberg here in a tax that, as I say, is not used anywhere in the world, and one more sentence, and under the House blueprint includes some aspects of an income tax because of their treatment of some financial flows, and some aspects of what is a typical value-added tax. And the idea of doing this quickly with, the usual people. I mean, I sat around tables in these buildings more than once when I was at the Treasury drafting statutes. And so I can imagine the conversations around the table drafting statutes, but my concern is that most of the people who will be around the table drafting this statute have no experience with value-added tax statutes. And in order to make this system work, you need to import lots of learning from the best practices of value-added taxes. And if we don't use those best practices, the idea that somehow you've achieved a great simplification and you've put the tax planners out of business is really foolish, because the tax planners are they're going to turn this into a snake, and it's going to bite the Commissioner of Internal Revenue.
I want to move to questions soon, but before we do, there's one important aspect we haven't touched on, and Gary, I'm going to ask you about that, which is VAT, border adjustable VATs are allowed under the GATT, under the WTO, but there's no provision, as far as I know, for border adjustable income taxes. What are the likely trade law consequences of adopting this tax?
Another good question, Greg. Again, you'll find people on both extremes. Some people will say, and have said, that this is perfectly consistent with the WTO rules, and others have said it's absolutely and clearly inconsistent. And I come right in the middle of that and say that if this is enacted in roughly the form contemplated in the blueprint, we can count on a good 4 years of litigation to determine how consistent or inconsistent it is. I don't think it's at all clear whether it's consistent or inconsistent, and it differs between exports of goods, imports of goods, exports of services, and imports of services. The rules are not the same for all these within the WTO GATT system. So there's plenty of fodder there for the lawyers to argue about, and a big point I try to make is that this will not be settled quickly in the WTO. Even if a case is brought, it will take 4 years at least to resolve it. So the bigger or the more immediate question, which I think Congress should concern itself with, is to try to get an assessment of which countries would resort to self-help and what kind of self-help they would do if they feel this is an offensive, a measure which is inconsistent with the rules. So there are two obvious kinds of self-help, but there are many imaginative people in the world who can come up with others. One obvious one with respect to U.S. exports would be countervailing duties, arguing that this entails a subsidy on U.S. exports in whole or in part, in which case they would gin up their countervailing duty administrative law procedures and impose a countervailing duty on such products as arguably caused injury to the domestic industries in the importing country. So that's one, and I think pretty obvious. The second one, which is not so obvious, is that some countries might adopt mirror image legislation, which would deny the deduction by their corporations of inputs purchased from the United States. Now, you think about that, you can see the impact that that might have on U.S. exports, since we export a lot of intermediate products as well as capital equipment. So those are possibilities. Then you have to ask who's actually going to do that. And again, that's another conundrum. I think it's highly unlikely that Mexico or Canada, which is about 1/3 of our international trade, would do either of those things. I think the big question mark countries are China and Europe. And so, you know, it could be quite something. But if cases are brought in the WTO, or if this leads to the kind of retaliation I just sketched right there, I think you could count on the U.S. then having a counter response to the retaliation. So in that scenario, one sees, I would say, considerable danger to the world trading system as we know it today.
Can I just,
I do want to follow up with one thing, Gary, though. As the economists here have discussed, the border adjustable tax is really a VAT. It's economically no more discriminatory or distorting than a VAT.
that's not correct.
Okay, so, well, let me ask my question anyway. Is it conceivable that, like, the WTO could be amended or the GATT could be amended to basically make the same allowance for this tax that is now made for the VAT?
Well, if you look at the numbers of possible countermeasures under the WTO system, they are just enormous. My colleague Chad Bone, it is all on our website, and so he calculated, you know, 40, 100, 120 billion dollars. I mean, way beyond any countermeasures imposed so far. So you would have to contemplate, if you want to save the WTO system, which has a tremendous value for the United States and all the participants, you would have to contemplate some renegotiation of the rules. And there is this fundamental issue, which has been really troubling during my whole career in the Treasury and here in Washington, that they can adjust their taxes and we can't adjust ours. It's as simple as that. It looks unfair. It looked unfair to President Trump, looks unfair to many congressmen and so forth. So, you know, these people who say it's unfair, they don't subscribe to all this smooth adjustment of prices and exchange rates and so forth. It just looks like they get to take their taxes off their exports and impose their taxes on our exports, and we can't do anything, and that's just not a level playing field. So you could see some adjustment of the WTO and GATT rules, which were written in large part, I mean, the original GATT back in '47, and now the rules on the export side were written in the Tokyo round, so that's another 40 years ago almost. You know, it's a long time ago, and this particular tax, I don't think you can say it's covered in the agreement on subsidies and countervailing measures. There is a provision for other indirect taxes, and I think the U.S. argument would be this is one of those other indirect taxes. And then on the import side, there's a question whether there's a product tax or an income tax, and people have opined on those, but I think modern economics would say there's no real distinction if you have a uniform tax between a product tax and a tax on income.
Can I interject here? I think that on the import side, the big difference between this tax and a value-added tax is that a value-added tax taxes all of the value that's added, whether from capital or labor, on both domestically produced goods and on imported goods, whereas this tax taxes the entire value added, including the labor component of imports, by denying the deduction. But it does not, because of the wage deduction, it does not tax domestic production the same way. And I think the likelihood, I thought Gary was going to say this, but I think the likelihood of the WTO finding a violation here whenever it gets to it, and I think it may be quicker than the history of of these cases is really close to 100%, despite the fact that an economist will tell you that you could do the same thing in a GATT legal way by having a value-added tax and then giving people payroll tax relief or wage subsidy of some sort or another. And I was on a panel with a different economist on Friday who said to me, well, I'm shocked that the way the legal system would treat it would be different than an economically equivalent transaction. And I said, well, you know, as a tax lawyer, that's the world I live in, right? Everything is treated differently. There is a overriding economic substance rule in the code that doesn't apply to the WTO, but the law doesn't turn on these niceties, and particularly the European lawyers don't turn on these economic equivalences. And so I think the likelihood of a WTO adverse finding is very high, and I think the likelihood of other countries responding before the WTO finishes is very high. I want to make one other quick point. We also have, in addition to our WTO arrangements with 163 other countries, we have 68 bilateral income tax treaties. And there is a question about what this tax is and how it works under an income tax treaty. And there are two possibilities, and I think this depends on how it's drafted. One is that it's an income tax and it's under the treaties, and you can draft it like that if you put it in the right part of the code. The other is that it's not an income tax and it's outside of the treaties. Either way, if it's an income tax, it's going to violate our treaties, and and many of our treaties new treaties require arbitration, and the U.S. will lose in arbitration. If it's outside of the treaties, you're giving up competent authority power, which lets the U.S. negotiate with other countries about transfer pricing and other kinds of issues when you have controversies. And here again, it's the same question that Gary was talking about in terms of how other countries will respond. So I'll give you just one example. So I've got a valuable trademark, think Disney or Coca-Cola or Pepsi-Cola or any number of other companies. And I've now operating where I've licensed the right to use that trademark abroad so that royalties are coming back into the U.S. Under this tax, those royalties will not be taxed, even though under the income tax they would be taxed. The other countries currently allow, under our treaties, a deduction for those royalties against their income tax, and they impose either low or no withholding taxes on those royalties. And the question then becomes, well, if we're not going to tax them, do you think the other countries are going to allow you to deduct them? And the former negotiator in the Obama administration of the OECD BEPS project said one day that when he was sitting around the table negotiating the BEPS project at the OECD, he always felt like he was in a room where everybody else wanted him to pay the bill. And here, I don't think that the other countries are going to stand still for allowing the U.S. essentially to strip the royalties out of their tax bases under circumstances where we are not going to tax it. This is the way that they're now reacting to tax havens, which don't tax this income, and they're beginning to try and tax it. So I think in terms of how other countries will react, they're both the trade dimensions and the tax treaty dimensions, and this is another, what I'm calling another major known unknown in the context of this legislation.
But I do want to emphasize.
I'd like to have a very short.
Excuse me, can I just
Sure,
say a little about
let's
this?
give it 60 seconds.
Yeah, okay, I mean, I really think, given the amount of time that they've.
Sure,
got,
yeah.
Okay, yeah, let me just emphasize from an economic perspective, I think that Michael and Gary are right, no doubt, about what the WTO rules do say, but let's just be clear that a 20% uniform import tax combined with a 20% uniform export subsidy is trade neutral regardless of how domestic goods are or are not being taxed. And so from an economic perspective, the thing that the WTO is looking at, how does the tax on the import compare to the tax on the domestic product? How does the rebate on the export compare to the tax on the domestic product? That's all irrelevant. What we need is just the import tax and the export subsidy to be equal to each other.
Greg, I have to put in a word on this wage issue, which Michael has raised, because other people have raised it, but they haven't read the policy brief, which Lucy Liu and I authored on our website. The point is that the Congress has plenty of clever people. They can deal with the wage issue by encompassing our Social Security and Medicare taxes under the cash flow tax, linking them, which is exactly what happens in the value-added system, and therefore deal with the kind of boxes which the appellate body and the panels at the WTO, try to put these taxes in various boxes. So I think that problem will be addressed as this works its way through the Congress.
So I read the paper, and I agree it could be dealt with, but it has to be dealt with the payroll taxes.
Okay. This has been fantastic. A lot more debate than I expected. If there are any questions, please put up your hand. We'll get a microphone to you. Yes, right here. Okay, sure. Just speak loudly. And can I get your name and affiliation, if you don't mind?
I think they actually want the microphone for the,
they don't-
for the
Okay.
web,
For the for the recording. Yeah.
for the web.
There we go. Hi, thanks. So it's Emily Meredith at Energy Intelligence, and I have sort of what I think is a basic question, and that is, what will happen to the revenue that Congress is trying to raise through the border adjustment mechanism if indeed we do have these price effects or the exchange rate effects?
Do you want to try that one, Alan?
Yeah, so from an economic perspective, there is no net revenue from a border adjustment in the simple model because imports and exports have to balance in present discounted value. You can have revenue come in during the trade deficit years, and those may persist for many decades, but then subsequently there'll be trade surpluses to service the external debt that's being run up, and of course the border adjustment loses money when there is a trade surplus. A lot of people have asked, well, okay, but if there's $1 trillion coming in, and nobody is really paying that, where is that coming from? And so in the simple model, the answer is that it really is being borrowed, that under a border adjustment, the government borrows from any foreigners who buy U.S. assets and then makes repayments to them as they receive payoffs on those assets. At the same time, it is lending to Americans who buy foreign assets and is collecting repayments from them as they collect the payoffs on those assets. In reality, when you move beyond the simple model and bring in the initial cross-border assets that we were talking about earlier, the border adjustment actually looks to be a revenue loser in the present discounted value sense because there are more assets that foreigners hold here than we hold abroad, as Michael had mentioned earlier. So this revenue gain really is tantamount to expensing, it is tantamount to borrowing. So it's a good question whether you really should spend it, which is obviously what Congress will do, I think, under the 10-year budget rules. To be fair to the House plan, some of the revenue loss that is recorded for moving to expensing, of course, is not in present value a full revenue loss. Part of that is really government lending. And so I think that the proponents of the blueprint could say, okay, if you want to kind of do the economics of this, you ought to do it on both sides of the ledger. But nevertheless, I must say I'm very disappointed at how much prominence this inherently temporary revenue gain is receiving in the debate.
Any other questions? Yeah, here on the aisle. Yes.
Hi, I'm Tegan Gelfand with CVS, and one part of the plan that I wanted to ask the economists about is driving away from a consumption system and all of the incentives for savings. And if you drive down consumption, what do you think the economic impact will be over time?
So a reduction in consumption, an increase in saving and investment, would obviously boost long-run growth. And I mean, all the models, I guess, that economists run tend to show effects like that, whether they, the magnitudes may differ across the various models. Obviously, the gain in future output and future consumption does not come for free. By definition, you're giving up consumption in the short run in order to finance that increased saving and investment. Nevertheless, this is a desirable policy change if you believe that the level of saving and investment is too low today, and given the taxes that we currently impose on saving and investment, it seems reasonable to make that conclusion.
Let me add one observation to that. Some of the opposition to this tax will be on distributional grounds. That is the argument that any tax which is imposed on consumption, and this is meant to be on consumption, hurts or comes more from middle income than upper income people because of the tendency of middle income people to consume more traded goods. It's a fairly subtle argument, but upper income people have more of their consumption in services which are not traded, restaurant meals, mansions, what have you. So you get quite a bit of, I think, regressivity argument against this tax springing from that. Here, I think I'm squarely with Michael Graetz on this issue. I really think it's a tremendous mistake to look at all business tax systems through this distributional lens. To me, if you want to deal with distribution, we have the tool, and it's the personal income tax. And dealing with it through kind of business taxes is, I think, terribly misguided and leads to the kind of tax system we have on corporations, which is quite harmful to our country.
I want to respond on the distributional point. I mean, the business cash flow tax, of course, as we've said, is a value-added tax with a wage deduction. So it's actually a tax on consumption minus wages. If we think about where consumption can come from, there's really three different sources of financing it as we go forward. One is wages that will be earned in the future. And obviously that's the bulk of consumption, and that a lot of that is done by lower and middle income people. But that's precisely the component that wouldn't be taxed under the business cash flow tax. And the other two components are the wealth that's in existence when you introduce the tax, and the other is any high returns, so-called above normal returns, that might be earned on new investments in the future. So the cash flow tax is only applying to those latter two items, the consumption that is being financed from capital instead of from labor. So this tax in isolation is actually quite progressive. Now, of course, once you strip out the wage part of consumption, the base is much smaller, as Michael mentioned earlier. And so obviously you have to raise revenue elsewhere. And of course, I guess that takes us to the bottom line, which is that you always want to look at the overall tax system. Now, I think the estimates show that the blueprint actually would reduce the progressivity of the tax system by a noticeable amount. But of course, there's nothing inherent in the structure that they're looking to that would have that result. With a different set of tax rates, you could maintain today's progressivity or even increase it if desired.
It's a huge
Michael,
mistake.
I think we should move along now with her. Any other questions? Yes, there.
Hi, Lori Sanders with the R Street Institute. So we've heard a lot about how the border adjustment would apply to tangible products, widgets moving back and forth. But one thing the blueprint is unclear on is whether or not it would treat financial services the same way. And I'm curious if we could delve into a little bit about what that would look like and what the committee should do, particularly for things like reinsurance, because we have a lot of concerns about making sure we keep, reinsurance for long tail risks prices low.
Anybody have any thoughts on that?
Well, I think services will be a very complicated issue for the Congress to deal with as it goes into the details, because the kind of tax planning which Michael outlined with a couple of examples, those just abound in the services area. And the additional margin which will come into play is the distinction between capital flows and services income. And there's just a lot of potential for treating capital flows as services exports or not services imports and so forth and so on. So there's a lot of complexity, but in principle, any service export should be exempted from revenue, and any service import should be not allowed as a business deduction.
I think for non-financial services, that's really right. There may be some ambiguity about trying to locate where the consumer of the service is at. The financial services do pose a special challenge for this tax, for a VAT, or for an income tax, but there are models out there for dealing with it, and I think each of them can be applied in the cross-border context. I mean, in general, these issues that would arise under this tax would also arise under a VAT, although I think Michael would probably want to remind us that the rate would be lower under the VAT, making them somewhat less consequential, and that the credit invoice method would address some of the problems that would arise that this tax would face some problems that the credit invoice method would address under a VAT.
Thanks. I think there was a question here on the aisle.
Hi, Chris Knight with Argus Media. It kind of seems like the way the Republicans are going at this, you're kind of jumping off a cliff and hopefully things work out. Is there any way that you guys could see kind of a border tax light or a phasing into the border tax to make, see how it works and avoid this kind of jumping off a cliff thing?
I think the chairman of the Ways and Means Committee has said that he intends to phase it in. I don't know exactly what he means by that, but he is talking about phasing it in. So I'm assuming it will be phased in, so you'll be walking off a cliff, if I can use the Roadrunner analogy, instead of jumping off a cliff.
I think a phase-in would be is a reasonable measure to consider, given the uncertainty that's been expressed about how the speed with which the dollar would adjust. There have also been discussions about exempting certain industries from the border adjustment. There's been discussion about allowing companies to choose whether they want to be subject to the border adjustment. Those ideas, of course, are horrifyingly bad, and if they make their way into the final legislation, an option that cannot be precluded, I think that whatever attraction the border adjustment might otherwise have would be seriously diminished.
Any other questions? Over here on the aisle.
Hi, Dan Shorts with the National Confectioners Association. I'm curious as to how uncertainty could play into this. A WTO dispute might or might not take years. Exchange rate adjustments, price adjustments might take years. In that time, how could the uncertainty of some actors trying to respond to these changes impact or possibly negate the intended impacts of the legislation? So specifically, for example, cross-border asset holders trying to decide how they want to respond to this. Could the uncertainty of their situation impact how this plays out?
I think the uncertainty issue is an important issue for businesses to try and decide, for example, whether they want to change their supply chain arrangements immediately after enactment or whether they don't. I would add one more uncertainty that we haven't discussed, which is that the Republicans have been talking about passing this through reconciliation, and tax reform historically has been bipartisan. And so one thing that could happen is that if the alignment were to change, if this is enacted, the alignment changes, and my former colleague at Yale, Steve Skronik, would tell you that it will, because after 2 terms of any president, they tend to change. It's not hard to imagine movement by the Democrats in Congress to repeal and replace this system, and this is a lot easier to replace. I can give you 3 or 4 little steps. It's a lot easier to replace than the repeal and replace movement du jour.
Do you still have a question? Yeah.
Hello, Laura Sherian from Lithuanian Embassy. I just wanted to ask, do you expect it to be a lot of exemptions in this new tax? Because there are some sectors like textile, like automotive sectors, manufacturing, that probably cannot survive with this import tax. And it would be probably impossible to give back manufacturing to United States or something like that. So that would be one question. And another, I just wanted to make sure that I understand correctly, the deductible will be only wages according to this new tax reform, or other things also?
You would deduct purchases from other firms as well as wages. Obviously, these industries, I guess, would claim that they can't survive the import tax because obviously they're not recognizing the response that would occur in the dollar or in relative prices. But I do think, I mean, I don't know how many exemptions, if any, will be added to the border adjustment plan, but clearly proposals to do that are surfacing, and so I think it's a very worrisome possibility.
I actually wanted to ask a slightly different question on exemptions, but Peter Navarro, the head of Donald Trump's National Trade Council, said that he would like the tax to be applied at different rates to different countries, depending on the extent to which those countries run trade deficits with the United States and may have currencies that are overvalued or undervalued. Is that feasible?
Well, that is totally inconsistent with the WTO. I don't think Peter Navarro, I don't think he's terribly fond of the WTO, but that is so evidently inconsistent that I think you could expect a very quick mirror image retaliation if you did that, because it's pretty plain as day. And I think therefore you have to work through the retaliation likelihood to do that. The most I can see, pursuing the line that you've just outlined, Greg, is that within North America, since we're so integrated under the NAFTA and the supply chains are so extensive, to me, it's conceivable that the three North American countries might all agree, as between themselves, not to apply border adjustments. That would be the value-added taxes in Mexico and the goods and services taxes in Canada and this BTA if enacted in the United States. But that would be possible within a free trade agreement. And the Europeans have tried to work out something like this, not very successfully, but they've worked at it for a couple of decades on their respective value-added taxes to cut down on the friction problem. But to pick out China, for example, and apply a high tax to China and a low tax to some country where we have a trade surplus with, such as Brazil or Australia, would, I think, immediately be met by a Chinese look-alike provision.
I want to congratulate you. I have a slide deck of 44 known unknowns, and that one, Greg, I didn't have in my list, that you'd have a different rate for different
I
countries.
should say I'm going by memory by what I saw in an interview, so I shouldn't necessarily swear by that. But it's a question that could, in theory, be raised, especially in the context of those who would like to use this as a way to address trade imbalances.
In any country, specific provision would also be horrifyingly bad economic policy, even if it did not prompt retaliation. And of course, it would be still worse given the certainty that retaliation would occur.
I think we have time for maybe one more. Yes.
Oh, thank you. Hi, Brett Quick with S&P Global. Just broadly, I'm wondering if each of you could share a little bit about what you think the solution is to the fact that the U.S. corporate tax structure does disincentivize companies to stay here and invest here and does sort of incentivize inversions. So whether it be a VAT or some other structure, what is the answer if it's not border adjustability?
If we could get our rate down to the Swedish rate, 22%. Now, the reason I single out Sweden is I know a little about the country, and I think most Americans regard it as a socialist country. But, very sensibly, they've adopted a low tax rate, as has Denmark, another socialist country. 22% rate by itself would be a big improvement if we didn't go all the way to the border tax adjustment.
But just a plain rate cut with...
Yeah, I mean, I'd like to do more, but if that's the most that this Congress can do in this once in 30-year opportunity to reform the business tax, that's far better than doing nothing.
My ideal system is a 15% rate, which puts us between Ireland and where the UK is going. And I've argued that you should pay for it with a value-added tax of some level and also adjust your individual income taxes. I think it's extremely important on the distributional question that we not look to business taxes to solve whatever progressivity we have. And one of the problems I have with the House blueprint, for example, is that although it is repealing the corporate tax and is substituting a cousin of a value-added tax, as we've talked about, it still says that dividends should be taxed at half the rates of ordinary income, which was a response to our double corporate tax. And if you've got a zero corporate tax, you know, why not tax shareholders at the normal rates, whatever they turn out to be? And the basic point here is that shareholders are not going to change their residence in response to a tax in the same way that businesses will plan around their taxes. Business capital and business locations and business headquarters ownership is much more mobile than individuals. And so you need to have a package. And we've only talked about the business side, but there are some disconnects actually with the way in which they're going to tax the business side and the way in which they're not going to tax the shareholder side.
So as with Michael and Gary, I think the key is to get the corporate rate down, you know, somewhere between 0 and 15%. But you know, how do you pay for that? I mean, if you pay for it by doing corporate tax base broadening, mainly slowing depreciation, that's actually likely to be counterproductive. So I think there's two broad ways that you can replace the revenue that would be more economically helpful. One is to tax shareholders at the shareholder level based on where they live. Eric Toder and I have a plan for that. The other option is to do a consumption-based approach, which would involve either a business cash flow tax or a full-fledged value-added tax.
If I could add just a very quick footnote, between the rates of 35%, which is the U.S. federal rate, or 40% including the taxes, and a 25% rate, there is zero correspondence between the tax rate and the tax revenue. In other words, that's an area where the Laffer curve actually works, and I've written this up and researched this, and other people say the same. You get enough on the base if you lower the rate that it compensates for the lower rate. So at least in that range, you can cut. Now, if you go down to 20%, 15%, yes, there'll probably be some revenue loss, but it's not for the whole cut.
Okay.
Greg, before everybody leaves, I want to thank you, and I want to thank Alan, I want to thank Gary, and obviously Michael. The gentleman who left earlier was from the IMF, and he asked me, what about Alexander Hamilton and a cash flow destination tax? And the answer is that Alexander Hamilton in Federalist 21 did support a destination cash flow tax, basically a consumption tax, but he did not pick a subtraction method VAT, nor a credit invoice VAT, nor a blueprint. So at least as far as I'm concerned, I'm in favor of the basic concept, and I'll let all you wise men in the legislative process figure it out. Thank you so much, and let's also thank Pinar who put it all together.
Favored a consumption tax.
Well, he just favored a consumption tax.
Yeah, so there's a vote next to this.
He didn't go.